Welcome to Financial Foundations 101. This presentation is encompassing all 7 areas of what Apprising feels is the most important to have a strong financial life. We'll highlight each of these areas. As we go through each one, please take notes and think about an idea or some actions that you would like to take as a result of this presentation, as we'll ask you at the close of the presentation to write down some action steps that you can apply as a result of what you've heard. Apprising, a national nonprofit whose mission is to help people improve their financial well-being through counseling, community outreach, and financial education. We are a 501c3 nonprofit corporation that's been in business for over 55 years. We have helped over 500,000 individuals and families learn to manage money, balance their budgets, and get out of debt. As a part of our mission, Apprising feels very strongly that getting and staying on track with your money is essential to one's success. So we have developed a 7-part educational series that includes workshops and webinars to help individuals prepare a better financial life. Are you controlling your money, or is your money controlling you? A great place to start with managing your money is to do a few exercises to find out what is going on currently with your finances. What would you like them to be doing for you, and what are your plans for the future? Let's start by setting some financial goals. One of the best short-term goals to start with is an emergency fund. Something you can start now with to cover large unexpected expenses to keep you from putting that expense on a credit card and paying it off over time. A good figure to start with is $1,000. That amount will get you almost anything covered and will allow you to start saving toward a goal immediately. What are some other longer range goals you want to look at? Look at taking a vacation, purchasing something that you have always wanted, getting a car. You know what your dreams are, so write down and see what you can come up with. What about long range, 5 years and forward? Starting a solid retirement fund, planning on a down payment for a home, your children's education? Writing down your goals gives them the opportunity to affect how you spend money and how you save money. If you have a goal in mind, you'll probably achieve it simply because you have planted the seed, and you see that seed every time you see these goals in writing. Write them down and put them somewhere you see them every day. The next exercise we want to look at is to see how you're currently spending your money. Track your spending over the next month. Write down when you spend money, how much and for what, and you can see what areas you'll be overspending in. You can use this information to begin planning on how your money should work for you. Next, we can develop a spending plan, not a budget. A spending plan puts you in control of your money, and you tell it where it needs to go to cover your needs, your goals, and your wants. List your monthly income. Do not include extras that you earn, but you're not sure of how much you'll get. Only include the amounts you know that will be there every month. You can use the extra money to pay down your debt or continue saving. These are the type of expenses we want you to plan for. First, the fixed expenses. These are the items you know exact amounts on. You have to spend this amount each month for these items. Could be a car payment, a mortgage, utility bills that are currently on a budget plan, monthly insurance premiums. Then there's the flexible items. These items you know you have to buy, but you're never sure from month to month how much they're going to cost. Food, gas for your vehicles, and other items like that. Then there's the periodic expenses. These are the items that you know you only pay for once or twice a year. Real estate taxes, car insurance, car license, Christmas presents, back to school expenses, vacation plans, things of that sort. Set aside accounts for periodic expenses. Use a separate account for your periodic expenses. Take the total amount that you will pay for a year on all your periodic expenses and divide it by 12. That will give you the dollar amount you need to put into this account or to save in order to cover them when they are due. Let's set up a periodic expense spreadsheet. Use a calendar to develop irregular expenses, and it is a great way to be sure that you do not forget to plan for those expenses. Keep this calendar handy because you may forget about the expense, like a vehicle registration, or birthday parties or gifts you have to get throughout the course of a year. School time is also an added expense with school clothes, school supplies, and school fees. You may want to add up the year, set a certain amount each month to go into your savings account for these expenses. I would suggest use a separate savings account for your periodic expenses. What are the things you can do to reduce your expenses? First of all, prioritize your expenses. Know what's important to you and pay less for what you need. Look at specials. Look at things you can get in bulk. Do you need a cell phone and a landline? You can afford to cancel landline maybe and keep the cell phone. Do you have to have all those cable channels or that specific cable package? Is there a cable company in your area that's running a special for new members? You can always ask to change or ask the company to match that offer. Are you eating out too much? Know the dining specials of the restaurants in your area, and if you do eat out, pick those. Have a weekly menu for your dinners, and stick to that menu when you do your shopping. Use a shopping list when you shop, and cut back on your entertainment expenses. Here are some other ways to decrease your expenses. Shop around for your car and home insurance. Make sure you have multiple policy discounts on each, and keep them with the same insurance company. Do your homework before you shop for any item. Know where the best deals are, and know how to get those best deals. Comparison shop and ask for the best price on large ticket items. Check any employee or membership benefits for discounted items you might have through your employer or through any club that you might be a part of. Here are some ideas on how to increase your income. The obvious one, get a second job or search for temporary work, using this resource to help pay down your debt and balance your spreadsheet and your budgets as well. Use community resources, barter your services, sell stuff that you have laying around the home on Craigslist, or have a yard sale and take what you earn to buy what you need. Turn a hobby into a part-time income. Now that we've started on the spending plan and it's in place, we would recommend you check your credit report. There are 3 credit bureaus that list your credit scores: Experian, Equifax, and TransUnion. Your FICO score range they'll be looking at is between 350 and 850. The lower the score, the worse your credit. The lower the score, the more that you'll be asked to pay for in interest on loans, car and home insurance rate, deposits on services and housing, and your job opportunities could be limited if your score is lower. Have you looked at your credit score in the last year? You are entitled to 1 free credit report from each one of the 3 bureaus each year. The only place you can get this free credit report is annualcreditreport.com. You can call them at 877-322-8228, or you can mail them the information they need in order to get that report. The credit score is not free, but you can purchase it for a modest price. You do, however, get your credit report, and that allows you to see what's on that report and how you can plan for the future from there. Everyone's credit report contains the same information. It contains identification and employment information, as well as any past places of the residence and things of that sort. It also includes account information and pay history on any loan or credit card revolving loan that you may have. It also includes collection accounts that may be added to that credit report, public records, whether it's judgments, bankruptcies, things of that sort, and inquiries from creditors and potential employers. The Fair Credit Reporting Act set in place a dispute process that is completely free. So why pay someone to do this for you? You can dispute this item yourself either online at annualcreditreport.com or do it by sending a certified letter to both the creditor and the credit bureau with a letter outlining the nature of your dispute. The credit reporting agency must get back with you within 30 days to report their findings. The CRA does stand for Credit Reporting Agency. If the negative information on your credit report is found to be accurate, you cannot have it removed. However, based on what type of credit was involved, it will fall off your report after a certain amount of time. For example, a Chapter 7 bankruptcy will stay on your credit report for 10 years, a Chapter 13 for 7, foreclosures for 7 years, hard inquiries for 2 years. Most negative information will be on the report for about 7 years. By going to annualcreditreport.com and pulling an Equifax report, it will indicate the date the item is to fall off your credit report and give you an idea of what it would look like as you get closer to those dates. Credit scoring was created to help lenders determine the amount of potential risk or default you may have when making a loan. There are hundreds of different scoring models. Lenders may have one that is unique to them. The most popular, though, is the FICO score. Credit scoring was started by FICO, which stands for the Fair Isaac and Company, in the 1980s. An independent, non-affiliated company is the most widely used model. The FICO credit score ranges from 300 to 850. 760 or higher would be considered great. Anything below 560 is bad. The 3 credit bureaus have their own proprietary scoring system as well as the independent FICO scoring system. Most lenders use the FICO system as the premium scoring benchmark. In all models, the higher the score, the lower the chances of default, the best rates, and the best terms. These are the 5 categories used to build your credit score. The biggest and largest would be the payment history, taking up 35% of that score. This records the ability you have to repay these loans on a monthly ongoing basis. If you can handle your loans well and you have a good mark on these each month, your credit score will be higher. The second largest category is the amount of debt. It's 30% of your FICO score. This considers how much debt you have and how much debt you have available. If you're using 30% or less of your revolving credit debt, your score will tend to be higher than someone who's using 50% or more of that same debt. The third largest category is the length of credit history. The longer you have a relationship with a credit card or a revolving account, the longer and better that will show on your credit report. If it's in good standing, obviously it becomes a good standing report. If it's a negative report, then it stands for the 7 years it's on there, and that could affect your credit score. The final two categories is the types of credit you use at 10%. This includes revolving, installment accounts, and mortgage accounts. If you can use all three of those together, that can get you the highest possible score in that area. The other side is the new credit, which also accounts for 10% of your score. Anytime you apply for credit and you're turned down or it's accepted, it decreases your score based on the fact that you now have a new card or a new account that you have to maintain. As you work through that and build that good credit history and a longer standing period, it will affect your score either up for good standing or down for bad standing. What can you do to improve your credit score? The easiest thing is through your payment history. Pay your bills on time every time each month, and that in itself will begin to improve your credit score. If you have debt, pay your debt down. Don't incur more debt, but pay down the debt that you have to reduce your credit utilization to 30% or less. Keep debts from going into collections. A collection account is always a negative account on your credit report. Even if you pay it off, it still has a negative effect. And don't apply for too much credit. Don't apply for those cards at department stores at Christmas time when they ask you to apply for them for a 10% discount. That just brings down your credit score. Now you know where your money's going. You understand your credit report. What's next? Building wealth. You started with an emergency fund of $1,000. That's in place. You're ready to go to the next category. Once that is in place, start an income buffer or a cushion. Put away 3 to 6 months worth of income, so if anything was to happen to you or your job and you couldn't work for a while or you lost your job, you'd still have the ability to maintain your spending plan for those 3 to 6 months. After you have that in place, let's look at ways to start saving more money and use that money to invest in your future. Everyone can save money. It's difficult to begin with, but once you start the habit, it becomes very easy to save that money. Set aside a certain percentage of your paycheck each month to go to savings. Take it directly from your check into your account by using direct deposit through your employer. You can also look at saving change, an easy way to save money and keep the change out of your pocket. Use paper money all the time so you can collect more change. Take dollars every few days and make it into change. Take your next pay increase. Use part of that, 1% or more, and have it automatically deposited into a savings account. Do this regularly and you'll see that you're able to save a little bit of money more often. The more you get used to saving, the easier it becomes and the more habit forming it becomes. Use your employer's 401k or retirement plan to build your long-term retirement wealth. Look at how much your employer may match you and make sure you're contributing an equal amount so you get the full matching amount. An 18-year-old who saves $3,000 a year for 5 years and earns 10% on his investment savings will have over $1 million by the time they turn 65. Whenever you use credit, it's best to know how to use it wisely. Credit used well can not only increase our wealth, but to better your lifestyle as well. Here are 8 smart credit management rules. First of all, know what you owe. Pull your credit report and find out who's on it and what they're expecting from you. Live within your means. If you're making $1,000 a week, spend $1,000 a week or less. Don't spend more. Spend less than you earn. Borrow only what you can afford to borrow. Recognize the warning signs of financial difficulty. You can go to our website at apprising.com and pull up the debt test and see if it's something that might affect you and how you are using your credit. Maintain a good credit rating by watching your credit and looking at your credit report annually. And guard yourself against identity theft. Always remember when you put an item on credit, if you do not pay it off immediately or within the same as cash term time, you'll be borrowing money at an interest rate that allows the company you borrowed the money from to make money off of you. This slide shows you how long it takes to pay back an account that you charge on at 18% interest. A TV at $500 at 18% interest with a minimum payment of 3.5%, which is the average most credit card companies use, would take you 5.5 years to pay that off, and you'll have paid $751 total for that one item. You can then see how it would affect the cost of a computer or even furniture and how long it would take you to pay that off. Most people who get caught in this trap are paying for items long after they've used them and thrown them out. This slide refers to the furniture example in the previous slide. The $88 constant payment refers to the minimum payment on the initial balance. Over time, the minimum payment will decrease as the balance decreases. But by paying the $88 off each month, you'll pay the full balance off in 3 years. Now that we've covered almost everything, we need to learn how to manage the debt that we acquire. A power payment plan is a system where a set dollar amount is applied towards credit card debt, whereas the payments are higher than the minimum payments on the accounts and is used to pay off balances quicker. It is important when establishing your spending plan you have a set amount that you are using for this purpose. By creating a spending plan, every dollar that comes into the household is accounted for within a spending category. Examine your needs and wants and lifestyle choices that are important to you when prioritizing your spending. Track your spending for 30 days to develop an accurate spending plan, and look for opportunities to increase your income. Get a job, another job. Find a roommate, sell your assets, decrease your expenses. Here's an example of how our power payment plan works, where the debts are listed as the lowest balance to the highest balance. This is done oftentimes because of the satisfaction of paying off a credit card and then going on to the next one. After paying one off, you get more momentum, you can add to the next one, and that allows you to pay the debt off quicker. The debt ratio is a consumer loan debt ratio that does not include mortgage loans. This type of debt the consumer has control over in the lifestyle and life choices they make, such as credit card uses or getting a loan. Lifestyle choices when someone buys a car they can't afford, putting the latest electronics on a credit card, taking out a student loan to pay for living expenses instead of tuition, or not calculating what the payments are going to be, or taking out a larger loan than the job you get is going to pay. This is the basic formula for finding your debt ratio. Take your average monthly debt payment, divide it by your take-home pay. That gives you the percentage of the amount that you owe each month in debt. Let's now take a look at bank account management. Let's look first of all at your checking account. Balance your checking account on a regular basis. Keep track of your expenses. When you use your debit card, remind yourself it comes right out of your check account. Use that to balance that the next day as you go from day to day. If more than one person is using an account, update the register on a daily basis. Don't forget to track your ATM and monthly service fees. Make a promise, make a vow, never to pay another bank fee again. When a checking account is opened, the account is automatically set up for the opt-out option. If you do not want your transactions to be approved at the point of sale, you will specifically have to tell your financial institution to do so.
Let's take a look at consumer awareness next. Payday loan statistics are very interesting. Why borrowers use payday lenders, we're not really sure, but most of them tend to use it for recurring expenses such as utility and loan payments. Payday lenders give you immediate access to cash, but at a tremendous cost. Fees, interest rates of 200 to 400%, and payments that are extremely high, sometimes unaffordable. Once in this place, a very hard place, it's hard to get out of, and it's not easy to get control of once again. Always beware of quick fixes. Quick cash often comes at a very steep price. The average interest rate for payday loans is 200 to 400%. Stay away from credit repair companies. You can always do this work on your own. Although time-consuming and sometimes laborious, it comes at a minimal cost to no cost at all, as opposed to paying $200 to $300 for somebody to do the job for you and then find out later on it's not been done correctly. Always ask questions up front regarding fees, additional cost, paying loans off early, or paying more than the minimum payments. Check with the Federal Trade Commission and your state's Attorney General's office before enrolling into programs or debt management programs to make sure that you're doing so with a reputable firm and a firm that understands your position and where you want to go financially. If you find yourself getting into financial trouble, determine what the cause is. Take a look at your spending plan. Figure out where you've overspent or where you haven't spent properly and make the adjustments you need. Take inventory of where you are and write it down so you know exactly who you owe and what you owe. Again, review your spending plan and make the necessary adjustments to make the trimmings or to add to the cost of what you need to get out of that trouble. Call your creditors. Don't wait for them to call you. Explain your situation and your circumstances and see what they can do to possibly help you out. Make an appointment with a financial service specialist from Apprizon. You can do that by calling 800-355-2227. We are open 6 days a week, 24 hours those days, Monday through Saturday. At the beginning of this webinar, we encourage you to write down some goals you may discover and you may want to attain throughout this course. Take a few moments now before you proceed to the next slide. Write them down. Start with a simple statement and then develop these into goals with purpose, with a timetable, and a solid plan to aim for the future. We'd like to thank you for viewing Financial Foundations 101. We encourage you to visit our website at www.apprizon.com for more information and tools to complete your financial goals and future. You can also call us at 800-355-2227 and talk with a financial service specialist Monday through Friday, 24 hours a day. Or if you'd like to schedule a one-on-one financial review with one of our counselors.